Right now, we are tending to be in the equity markets very bottom-up, taking a very bottom-up approach and looking just at individual companies. I think it was the top 320 non-gold funds, only 30 of them had any gold stock in the portfolio at all. It's pretty astonishing. That means 9 out of 10 have nothing.
All right, today we're having a chat with Adrian Day from Adrian Day Asset Management. Of course, value investor, precious metals, commodities, financial analyst. Plenty of topics to discuss today. I would love to start with gold. Of course, gold is already up 100% since 2022. Crazy return for a 3-year period. Is the precious metal slowly but surely getting oversold, Adrian?
I'm not sure it's getting oversold. I wouldn't really put it that way. But I would say, I think there's an awful lot ahead for the precious metals. And if I may use a cricket analogy, to me it's just like the second and third batsman went out. Which means, if you don't understand cricket, we're very close to the beginning. We're nowhere near the end. So I'm just not sure it's oversold at the moment. I mean, for the last, 3 months, it's been in a kind of narrow, reasonably narrow range, sort of responding to news in a way, but I think waiting for a major development either way. And I do think there's a risk of gold correcting in the near term if sort of multiple things come together. If we get a series of trade deals, we got one with Japan, but if we have other trade deals, maybe, Korea, but maybe even the EU. And at the same time, the economic news is reasonably good, so the Fed probably wouldn't cut sooner. Maybe even some geopolitical, I have no idea what's going to happen in Ukraine, of course, but a confluence of events could come together that would make gold correct. In that case, I wouldn't think the correction would be very deep or indeed very long. And that's simply because the fundamental reasons why people have been buying gold over the last 3 years, whether it's central banks wanting to diversify away from the dollar in the face of dollar weaponization, whether it's Chinese non-official wanting to buy because of concern about a devaluation of the yuan and the fragility of a banking system, whether it's wealthy families around the world or individuals around the world wanting to buy because of concern about the US and other countries' fiscal problems, none of that's gone away. None of that has gone away. So any correction, in my view, would be a very short-term and shallow one.
I figured your answer would be along those lines. Very much appreciate that. Perhaps we can talk about really what your main thesis behind gold is. You started highlighting some aspects there, of course, central bank buying. But really, when we try to go back to the base, why is Adrian bullish on gold?
People buy gold because it is an asset that's no one else's liability, and because it can defend you, insure you, whatever word you want to use, hedge you against financial assets in an uncertain world. So to me, the increase in uncertainty and volatility, frankly, but the increase in uncertainty is what drives people to gold. And that's, again, whether you're a central bank or whether you're an individual. Now, I tend to I don't put an awful lot of emphasis on geopolitical events, because if you look at the history, frankly, if you look back even to the late 1970s with the Iran, before you were born, even with the Iran hostage situation, geopolitical events tend to only have a very short effect on the price of gold. It tends not to be the fundamental longer-term driver. Now, if you have a geopolitical event when gold is already moving up, such as the Iran hostage situation in 1979, then that has a bigger effect on gold. But even unless the perception is that whatever that event is going to get worse, it doesn't seem to be very long lasting. And a perfect example of that, of course, is the Russian invasion of Ukraine. Gold moved up for the 6 weeks before the invasion on anticipation. The troops were massing at the border, and there was a lot of discussion about will they or won't they. And then when they actually did cross the border, that was almost a peak. And within 6 weeks, gold was back to where it was before gold moved up in anticipation. And you often see that, and with an unexpected event, such as, say, 9/11, which was totally unexpected, gold moved up meaningfully. But if you look at, I would argue, if you look at gold's performance over the next 12 months, it was much more a monetary phenomenon than a geopolitical phenomenon. That was a long answer, I'm sorry. So anyway, I don't put a lot of emphasis on that. I'm certainly not someone who thinks that gold is primarily and certainly not only an inflation hedge, because there are many, many other assets that will protect you in inflation, and frankly, some of them do just as good a job as gold, empirically. And if you look at the history, gold actually performs better during deflationary periods than it does during inflationary periods. And when I say better, we have to say better in real terms relative to everything else, all of the other assets. Obviously, in an inflation, gold performs better in nominal terms, but in real terms, it does better in deflations. So I think it's primarily, that's a long answer, I'm sorry, but I think it's primarily the uncertainty that drives people towards gold.
No worries. Please take your time in these answers. Really appreciate all those insights and those side steps. But if I understand your answer correct, it's really looking at it as a hedge against uncertainty. That's why you think someone should have gold in their portfolio.
I think so. And that's for institutions as well as for individuals. Now, there are obviously specific things that drive individuals. If we look at North Americans, for example, they are typically driven to gold in a certain economic environment. In North America particularly, in North America generally, US and Canada, there is not that sort of tradition that you have in Europe and indeed in Asia of buying physical gold as a insurance. We just don't have that kind of tradition. And people will typically turn to gold when the economic environment is conducive. That is, the economy is slowing, meaning, maybe the Fed will ease monetary policy. When interest rates are low and falling, and particularly when you have negative real interest rates, and when inflation is high or rising, and when the dollar is falling. That's the sort of economic environment that will make US investors turn towards gold. And of course, if you look at the last 3 years, other than the last 6 months when the dollar's fallen, that's been exactly the opposite of the environment. The economic environment for the last 3 years has simply not been conducive for a typical American to want to buy gold. And that's why we have this huge dichotomy. People are often saying, well, where are the investors? We've got outflows from the GLD. Coin dealers tell me that, they're very busy, but they're busy with people calling to sell, not to buy. And people are saying, what's the disconnect between why don't North American investors get it when even Europeans now get it? And I think that's the main reason, frankly. But it is shifting.
If I understand you correctly, that perhaps could also be a type of afterburner effect for this gold bull market once those American retail investors finally turn around and start being interested by that precious metal.
Absolutely. I think absolutely. I mean, you look at various surveys in the US, family offices have less than 1% exposure to gold assets. Registered investment advisors, 78%, so almost 80% of registered investment advisors said they had between 0 and 1% I wish the survey had asked how many of you have 0%, because I would bet an awful lot of those 0 to 1% were actually zero. Generalist funds, you know, if you look at generalist funds, the top three, I think it was the top 320 non-gold funds had, only 30 of them had any gold stock in the portfolio at all, which, you know, is pretty astonishing. That means 9 out of 10 have nothing, and those that do have it had a very, very small amount. So there is no, the sentiment in the US is just very, very, it's not negative. It's just nobody cares, which is actually, from a contrarian point of view, I think that's the most favorable environment out there. You know, nobody's making a big case why they don't like gold. And then you've got this survey. This is conducted by the Bank of America. They do it every month, of global money managers. Last month, over 60% of global managers said that gold was the most crowded trade. Now, to me, a crowded trade is when everyone's in it. It's not that I think it's overvalued. A crowded trade is when everyone's in it, and that simply is not the case right now. How people could say that gold is a crowded trade, I don't know. Maybe the guy, I suspect what that means is the guy's buddies at the golf club all say they've owned gold and how well they've done. This guy doesn't own it, so he's ticked off and says, well, it's obviously a crowded trade.
Yeah, no, that sounds about right. And talking about that contrarian mindset, value investing, perhaps looking at gold equities, miners might be an interesting place to look. When you look at the gold price, like I said, up 100% in the last 3 years, the price to NAV ratio of those companies might have gone down in that time period. Is that a place where you're currently finding a lot of value opportunities in the gold miner space?
Absolutely, it's very good value. You know, Oscar Wilde, I don't know if you know Oscar Wilde in the Netherlands, but Oscar Wilde's an Irish playwright, well, was an Irish playwright 150 years ago. But he had a quip that there's a lot of people who know the price of everything and the value of nothing. And I think what you've seen is, like the gold stocks, they're up almost 60% this year, right? And so what I'll call a regular investor just looks at that and says, oh, I've missed it. You know, they're up 60%. What they forget, if you look at that's the price. If you look at the value, and I must admit, you know, if I'm doing research on the stock, if I see the stock chart and it's up 60% this year, I probably won't go very much further. And that's the reason, frankly, I mean, I'm going on a tangent now, but that's the reason, frankly, when I'm researching a stock, I never look at the price or the graph until I finish my analysis. And there's obvious advantages to that you don't let price influence whether you think it's a good deal or not until you've decided on what it should be selling at. The downside to that, of course, is you spend an awful lot of time sometimes looking at things, and then when you finally get to look at the price, you say, oh dear, maybe not today. But anyway, but if you look at the valuations of the gold stocks, number one, what people forget or don't think about is if the price of gold moves up 60% this year the price of gold is up about 30% this year. But as you said, it's doubled over the last 3 years. If the price of gold goes up like that, doubles over 3 years, then the NAV of the companies goes up. If the price of gold moves up faster than the costs are going up, the margins are expanding, and the cash flows are expanding, and the price to cash flow margins, multiples, come down. So the price to NAV multiples have come down over the last 3 years. The price to cash flow multiples have come down over the last 3 years. And so the valuations of the gold stocks, I'm talking here obviously about the bigger miners, the valuations of the mining companies are actually lower today than they were 3 years ago. And you look at a company like, let's say Barrick, which is the number 2 gold miner in the world. I know Barrick has sort of its own geopolitical issues, unique to it. Who else would be pinning their future on Pakistan? But anyway, but that's all reflected in the NAV, right? When an analyst does an NAV analysis, he does, or he should, put a bigger discount on a developmental project in Pakistan than a mine in Canada, right? And so if you look at Barrick and its price to NAV, it is in the lowest decile of its entire history. Now, that simply doesn't make sense when the gold price is so high. Barrick has a lot of copper as well, of course, so the copper price is high and the margins and the cash flow are so high. It just doesn't make sense. And you could do the same analysis. You look at Agnico Eagle, which is, in my mind, the gold standard of gold mining companies. No geopolitical risk, or as low geopolitical risk as you can get. Good balance sheet, very, very good pipeline, world-class assets. And if you look at the price to cash flow of Agnico, it's selling in the lowest 20% of the last 40 years. Again, doesn't make sense. So yeah, I think the gold stocks remain good value. And of course, if gold goes up to 5,000, these stocks are going to go meaningfully higher.
Yeah, no, definitely. And talking about gold stocks in general, you of course were talking about a lot of majors of them. How far willing are you willing to go on the quality curve downwards to try to get a bit of alpha? Are you willing to look at developers? Are you willing to look at juniors, of course, as a value investor?
Oh, absolutely. I'm willing to look at and buy very, very small companies. In my time, I bought companies as low as, 5 million or 10 million market cap. I don't buy those in the fund that I manage for various reasons, compliance and regulatory reasons, but that's a different issue. To me, and I'm saying extremes with 5 and 10 million, but we buy a lot of stocks that are 100 and 200 million dollars, which most people regard as microcaps or something. I don't, but so a lot of people will assume that size equals quality. And if size equals quality, then small size must mean low quality. And of course, that's not true at all. You can have a smaller company. If it has good management and a good balance sheet, that can be just as good a quality and as a bigger company, and I would argue it's better quality than a larger company with bad management and a lousy balance sheet. So, the big issue about small cap stocks, of course, to me, is the liquidity, because it's just much more difficult to get out of them. We're never concerned about getting in. Somehow with small cap stocks, you can always buy as much as you want, but try to get out of it, that's different. So liquidity is the issue. And so if I'm buying, so yeah, absolutely. If let's say the fund gets this huge influx of cash, and I just feel like we've got too much cash in the fund, I really ought to buy something. Okay, I can buy Newmont 1,000, 2,000, 10,000, 20,000 shares, knowing that if I change my mind or need the cash, I can get out of it. It's not a problem. And that, of course, does not apply if I want to buy, Ajax Exploration. And so I will be much more certain, the smaller the company, the much more certain I want to be. But it absolutely doesn't mean I won't buy them. That's where, as you implied, that's where some of the big returns come from.
Yeah, and especially if you look in the mining space, you have so many companies that are quite mismanaged, a lot of dilution, not very shareholder appreciative, and sometimes you have to go down the sizing scale to find those high quality management teams that are well aligned with you.
There's been a lot of bad management in the mining sector. First of all, look, we should think that the mining sector is a very small sector. So even now, after the big run we've had in the last year, gold stocks worldwide are probably around 700 billion total market cap. That's worldwide. That includes exploration stocks. That includes everything. Well, 700 billion compared with 15 trillion for just the top 5 tech stocks. So if you're top of your class in Wharton Business School, are you going to look at the gold stocks for where your career lies? Probably not. And so the gold mining industry historically has not attracted the best and the brightest. Now, having said that, there are some having said that, certainly it's changed over the last 15 and 20 years. There's no question about that. I think, generally speaking, the management of both the large and the small is better today than it was 20 years ago. And also, having said that, you've got some very, very good people running mining companies. I mean, Mark Bristow is controversial, but no one disputes that he's a very good CEO and manager. Look at Agnico, and you had Sean Boyd for what, 30, 40 years he's been at the company, and now the new president and CEO, Amar El-Jandi, is just top rate. You don't get better managers than these people, better CEOs. So there are some good people. When you go lower down the scale, the problem is you have a lot of people who just like gold and want to run a gold mining company. And so you have, as you suggested, you have far too many small companies with high overheads. If they don't have any revenue, then dilution, they have to raise money through equity, and dilution is a huge problem with these small companies. I mean, I was just looking at one the other day. I was just using it as an example. But in 7 years, it had gone from 5 million shares outstanding to 220 million shares outstanding. And although the company is doing reasonably well, it's difficult to argue that its value has gone up 40-fold in that period. Dilution is a real killer. And that's why we were talking about smaller stocks, how low down, how small are you willing to go, and everything else. I like to look at companies that have a good balance sheet and ideally have either cash flow or the ability to raise money. That might be a line of credit with a bank. It might be very strong insiders, wealthy insiders. But I like to know that if they need to raise money, they can do it in a reasonable manner, or they can draw down on their debt.
Great, thank you for that overview, Adrian. I think we understand that in the precious metals miners and the gold miners there's a lot of value to be found. Perhaps we can talk about some of the other areas where you're currently finding value. Is silver something, and the silver miners something that you're looking at currently, with silver close to $40 an ounce?
Yeah, well, of course, most silver is byproduct silver, as you know. There's very few pure silver mines, relatively few pure silver mines. And something like 75 to 80% of silver production now is byproduct, which again is completely different than it was 40 years ago before you were born. And so given that, you actually find that most silver is inside companies that are primarily gold. So you look at, for example, a classic case would be Pan American Silver, which is the second largest silver producer out there, and yet last year 18% of its revenue was from silver, and this year, even with the higher price and with the acquisition of Mag Silver, because of the higher price of gold as well, most analysts are expecting it to be about 23%. And that's your second largest silver mining company in the world. So when you say, am I still finding value in the silver companies, I'm not really finding value right now in the pure silver companies. And I won't name the names, but companies that are pure silver miners or pure silver explorers. Most of those have had pretty good runs. But if you look at a Pan American silver, which tends to be relatively responsive to the price of silver, I think you've still got good value in companies like that. Yeah. But I tend to look at them more as just precious metal companies, to be honest. So we're also finding value in copper. Uranium is interesting because with the correct pullback in uranium, the uranium stocks really didn't seem to pull back very much. So all of our uranium exposure right now is in the physical trust, UU. Yeah, that's the only thing we own right now. When we had that bit of a pullback, I sort of said, oh, let's see if I can buy some miners or exploration companies, and I didn't see any of it looked but screamed out at me. But yes, certainly in the commodity space generally, we're finding good value. And again, people have to stop looking at how the price has gone up over the last 3 months and look at the value. If you step back, I think there's a growing awareness of this, but if you step back, commodity prices today are virtually at their 100-year lows relative to financial assets. Doesn't mean they can't go lower, but I mean that's certainly something, that's certainly an indication of relative value, and it's certainly something that a contrarian should look at. And if you look at resource mining stocks, they are also at a 100-year low relative to the broader market, but by a meaningful margin. They've never been anywhere close to this cheap relative to the financial assets. Now that probably suggests that the financial markets are overvalued as well as the commodity being undervalued. But just look at the amount of commodity stocks that are in the S&P. I can't quote you the numbers now, but the commodity stocks in the indices are much lower percentage-wise than they were, even 10 years ago, let alone 20 years ago. So all these sort of indicators suggest that they're cheap. And yeah, I mean, we're finding some good value there.
Great, thank you for that overview. And yeah, it seems those arbitrages seem to close indeed in both directions, not just one. Touching base on oil and gas, if you look at that space, there's opportunities to be found that are paying a 10% plus dividend if you're willing to go down the scale ladder. Is that something you're looking at?
Yeah, first of all, I'm really not an oil and gas expert. I think the problem has been, of course, a general oversupply or overcapacity. But I think what we're seeing right now is the area that has been the main contributor to growth in oil, right? Not the main producer, but the main contributor to growth over the last really 7 or 8 years has been the US shales. And over the last, let's say, 50 years, you've had different sectors around the world, the different basins that have become the main driver of growth. In the 50s and 60s, it was conventional US oil. In the 60s and 70s, you had North Sea oil and Mexico, the big discovery in Mexico. So, but for the last sort of 10 years, it's been US shale. And US shale has peaked, and it's on that decline slope now. Doesn't mean they won't find more, and it doesn't mean that it's running out tomorrow. It just means that the contribution of US shales to global growth in oil production is slowly going to decline. And not so slowly, because shales, as you probably know, have a much steeper decline curve than conventional wells. So I'm getting attracted to oil. Yeah, I mean, we own we own a LP called Dorchester, which is US, solely US, but is well diversified within the US. That's a 9% dividend yield. That has a reputation, Dorchester has a reputation of being one of the sort of best, well-managed of the LPs. And it's also, as I say, what I like is it's diversified. There's a lot of LPs with higher yields that are focused on one particular basin, which obviously has its own risk, just like a mining company that only has one mine. I mean, you have a risk there. Yeah, so we're beginning to step our toes into it, but mostly with larger, like we just bought Chevron after they won the case against Exxon on the Guyana, Suriname assets. Guyana, yeah. Yeah, so we're just beginning to step into it. I don't have the highest conviction on that. I certainly don't have the highest conviction on time. And that's why I'm sticking with ones that either pay a good dividend or are the larger companies.
Getting paid to wait on your thesis is always a great position to be in. Are you also
not
willing
bad.
to... Sorry?
It's not bad.
No,
I mean, the biggest
bad.
thing is you want to make sure, you want to minimize your risk if you're waiting. You want to minimize your risk as much as possible. So I look at, I'm avoiding companies with a lot of debt, for example, that might, and I'm certainly avoiding companies that are only in one location. Yeah.
Makes complete sense. Are you also willing to look at some smaller niches? I know, for example, tungsten as a material has recently been performing very well, and some developers on the back of that as well. Is that something you're willing to look at, or is that too small for you?
Well, I'm willing to look at anything, frankly. If I think I have, what I don't look at, I'm talking generally now, because we're global managers, not resource. We've only talked resource so far, but what I don't look at are things where I have absolutely no expertise, such as technology or biotech or sectors that I just plain don't get, like social media. But other than that, I'll look at anything. My sort of general principle is a little bit too strong a word or highfalutin, but my general approach, that's a better word, to things like tungsten is I would rather get that inside another company that I like anyway. And so whether it's a producer or whether it's an explorer, I would look for companies that I like anyway, but they have some exposure, and if the sector does well or they make a discovery, we'll benefit. But yeah, I don't have any pure tungsten at the moment, or lithium or scandium or anything else.
All right. And quickly touching base on that global perspective, of course, if you look at the US dollar as a currency, it's quite weak as we speak, historically speaking, compared to the other currencies. Is that something that's also driving some bargains in the US to be found? Because you have that cheaper currency, it's cheaper to buy that company than it was, let's say, 6 months ago?
Well, for global managers, for non-US managers, it is producing some bargains. For a US manager who, counts the measuring stick as US dollars, it doesn't really have that same impact. The problem, of course, is that the current US administration is not making the US an attractive destination at the moment, and so despite the decline in the dollar, you're seeing global managers put much less into the US than they were last year and the year before. In fact, almost because of the decline of the dollar, because people are wondering if it's going to continue. The dollar has declined on the index. The dollars went down in the first half by 11% or something, but people get confused about, currencies, as you know, they might be very, very volatile in the short term, but they typically don't have huge, unless we're talking Venezuela, they don't have these huge moves. Like, if you're a gold investor and someone says it's down 11%, okay, so what? But that's the largest first half decline in the dollar since 1974. So I would say that the dollar is probably oversold in the near term. Having said that, the recovery has been kind of anemic, but I do think it's oversold, and there's a potential for a recovery. Particularly if U.S. rates remain continue to have that relative yield advantage, although that's not what's really driving currencies at the moment, as you know. But if the US gets a bunch of trade deals done and sort of says, hey, we're really your friend, don't worry about us, that could see a bit of a recovery in the dollar. But, longer term, I just think the more the dollar loses its sole status as a reserve currency, then the more, the decline is going to continue. And by that I mean, in the past, if you look back at what happened, Britain, the British pound was the global reserve currency, and it ceased to be, and the US took over. And before that, the French franc was the reserve currency, and before that, the Dutch guilder. But one currency was the reserve, and then it was replaced by another currency. Right now, I'm not seeing that happening anytime soon, because for all the obvious reasons that people talk about, there is no obvious alternative. But the US can lose that sort of exclusive status if more and more reserves are put into assets other than the dollar, if more and more trade, because there's two sides to this, trade and reserves, if more and more trade is done globally in currencies other than the dollar, if the US is putting tariffs on foreign countries, which is going to reduce the amount of exports of goods that they export to the US, so they're going to be earning fewer dollars that have to be recycled into our markets, both stocks and bonds, all of that, diminishes the dollar's attractiveness and the reality of it being the sole reserve currency. So I think you're going to see that happen, slowly, but you're going to see that happen over the next several years. And as we know, it already has. You look at the dollar, you go back to the beginning of this century, at the end of 1999, global central banks held about 75% of their reserves, foreign reserves, sorry, that is, not the British pound for the British bank, for the Bank of England and so on, but their foreign reserves were held in the dollar. 5 years ago, that had declined to about 65%, and now, as you know, it was big news because gold has overtaken the euro, but right now the dollar is about 47% of global central banks' non-foreign reserves. For institutions like central banks, who don't trade reserves or anything, that is just an astonishing decline. And it didn't just happen this year when Trump came in. It's a long-term trend that was going on long before Trump came in because of a lot of reasons. I think it's fair to say that Trump hasn't done anything to slow it down, but he didn't cause it or start it. And I think you're just going to see a continuation of that trend. At what point does it stop? I don't know. There's probably some banks out there, maybe Switzerland, maybe Britain, that say, it's fine, we're diversified. But there's some banks that probably say, if you're worried about weaponization, if you're worried about confiscation, maybe any dollars is too much, as it was for Russia.
Yeah, that world reserve currency discussion, so many threads I could pull on there. Being conscious of the time, I would love to squeeze in one more question, if that's okay with you, on actually the other way around. If you're looking at European stocks, UK stocks, for example, the multiples seem to be a bit more benign, a bit lower than the US counterpart. Is that an area where you're finding a lot of value?
Yeah, I mean, generally speaking, I think most developed market equity markets are overvalued today. Some more so than others. But Europe has had more inflows. It's had inflows from the US this year, or earlier in the year it had inflows from the US. And also, of course, if fewer money is going from Europe into the US market, a lot of that is going to stay in Europe. Right now, we are tending to be, in the equity markets, very bottom up, taking a very bottom up approach and looking just at individual companies and what we own and what we're buying is frankly quite eclectic right now. And so I will start with the bottom up analysis, and the top down analysis comes into play either if I have a very, very strong and negative view on the top down affecting that particular company, or if my weighting to a particular sector or a particular market gets overweight. But I'm finding a lot of value right now. I mean, we're finding a lot of value in the UK market, notwithstanding the awful government they have and the mess they're making of the economy and everything else. But the UK market looks attractive. We're finding an awful lot of attractive equities in the Hong Kong market. Now, of course, the Hong Kong market, you know, it's really China now, unfortunately. And really unfortunately. So you do have a huge risk if a conflict erupts between the US and China, or the US does to Chinese stocks what they did to Russian stocks when they invaded Ukraine. So there is a risk, but is maybe a reasonably small risk, but it's a big risk if it happens. But having said that, there are some very, very good quality companies in Hong Kong that are selling at ridiculous valuations. I'm talking, 20% of book value, and companies selling at 3 times, 4 times earnings. And not because of a spike in earnings, just the stocks are really cheap. So we are overweight Hong Kong, and we're also overweight Singapore. We're also a little bit overweight UK, but we're finding good buys in many areas.
Perfect. Thank you so much, Adrian Day. Perhaps you can also highlight how people can get in touch regarding Adrian Day Asset Management.
Yes. Well, the easiest thing to remember is just my name. So if you go to www.adrianday.com, it'll take you to the money management section.
Excellent. We'll also make sure to put the link in the description. Perhaps you can shortly outline really what you guys do over there and for who this might be interesting to reach out.
Oh, thank you. That's very nice of you. We have 2 businesses. One is a newsletter, and then a paid subscription newsletter, and then the other one is the money management. In the money management, we invest globally. Our accounts tend to be individualized. So a person, for example, could say, I want conservative global account, but I really want more gold than you would normally allocate because I like gold. We have people who say, I want a gold account, but don't buy me any of those seniors. I can do that myself. I just want juniors, or vice versa. I'm 80 years old. I just want to have some gold, but I think I should only stick with the conservative ones. So we can individualize accounts, and as I say, we manage in global accounts, but we also have dedicated gold and resource accounts. We're not head up on minimums. Minimums for me are whatever makes sense to the client. If it makes sense to the client, and it's enough to at least get a bit of diversification, we'll do it. Obviously, larger accounts can have more diversification. In a larger account, you can afford to take more risk, individual risk, which is where your biggest returns come from. If we have a $50,000 account, I'm not going to put 10% into something that might blow up and lose all this value, obviously. That's about it, yeah. And we can take clients from many countries. You'd have to ask us about the specific circumstance, but we can take accounts from most countries, not Australia, and not EU, unfortunately. But and we can hold accounts either in the US, or we have custodians in Europe, as well as in Singapore.
Thank you so much for your time and your knowledge today, Adrian. Really appreciate it.
Well, thank you very much. Yeah, this was really good. I hope we can do it again.